Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review, this time for the week ending July 11, 2025. So another quite eventful week on the tariff front. The title of the review this week is "This is the final stretch toward August 1st. The deadline used to be July 9th. And now, it's been pushed to August 1st. Donald Trump is sending those letters to pretty much every government in sight with their tariff number. Canada got its letter very surprisingly yesterday. No one was expecting this, not yours truly or anyone that I had heard from. And now the deadline seems to be for a deal on August 1st. If not, tariffs will be much higher on that date. So that leaves about 3 weeks for negotiation stretch. We already had 90 days of negotiations with very little to show for it on for the Trump administration. So can be skeptical if anything will be any breakout will be coming by August 1st. But still, this is the world that we live in. So if we start with a look at this week's markets at the close on a Thursday. So negative for bonds, rates were a bit higher. For stocks, still positive. It's another solid week in. Canadian stock market continues to lead the North American indices by a fair margin, especially if you bring everything back into Canadian dollars. We're up about 11% since the beginning of the year. Europe is the leader in Canadian dollars, 14% higher. Emerging markets between 10 and 12%. If you look at the U.S. stock market, it is getting expensive. It is getting, let's say, complacent. The market seems to be complacent because it's not reacting to all of those trade announcements that we're hearing, which will, if enforced, be detrimental to the U.S. economy. But there are still very interesting opportunities in the markets. We'll take a look at all of these in the next few slides, but just maybe to brief you on where we are in our discretionary trading and in our thinking. Well, first, we still have a negative view on the U.S. dollar, and we're still positive on the Canadian dollar, the euro, and the yen. And you're seeing on the table on the bottom, we've had a bit of a consolidation this week after a fall of the USD of about 10% since the beginning of the year. But still, we are still holding a very positive view on the CAD and on the euro going forward. We did instill a few new trades. First, you see gold at the bottom. Gold is up 27% year to date, but all of this came between January and mid-April. Since mid-April, the price of gold is volatile but going sideways, so pretty much flat. We are looking at the drivers of gold, and we see that the most important one seems to be the demand from central banks. And the central banks are moving away from the USD and moving into gold. Of course, this US versus the world kind of story that we're experimenting with now in the markets should continue to support the price of gold. So we went back into the gold trade this week. We had been out for a good while. Now we're getting back in. We'll see if the impulse starts right away, if we need to be patient, but we think that it's a good opportunity to bring gold back into the portfolio for also the portfolio considerations that it brings with diversification and geopolitical risks and all of this. And also looking at the month of August, which tends to be volatile in the markets with low liquidity. We did put in some protection in case the US stock market would have some volatility downwards or some sort of correction or some sort of market event. So we are still very constructive long term on financial assets, but the US stock market, we do think that there are some better opportunities elsewhere, and it's appropriate to have some protection in. But we'll dig into the asset classes in a few minutes. Now, maybe an update on tariffs. I kind of started this slide tongue-in-cheek somewhere in March, I think, thinking it would be a thing of a week or two, but we're now 4 months in, and every single week it's a staple of the review. Trump announcing 50% tariffs on copper taking effect August 1st. So now it's 50% on steel, aluminum, and then copper. Again, the same thing as for the other metals. The US does not have the capacity to become autonomous on copper. It needs to import. There's no way that it can bring all of this production domestically, and the US is too small as a part of the US copper market to be a price maker. It is a price taker. Just to give you an idea, the US consumes between 6 and 7% of the total copper demand in a year, so it's 6-7% of the market, and Asia is 70%, so 7-0. So the US, if they put tariffs on copper, they will not force any exporter to just bend the knee and just sell copper cheaper to the US, because if there's one thing that is easy to just export to someone else, it's commodities. So you don't have to rebrand it, you don't have to adjust the product for a different market and different regulation. You just, you need to rewire your supply chain, you need to have deals with a ship company so that you can ship copper to Europe or to Asia rather than put it on a truck or a train to the US. But still, it's pretty easy to sell copper and aluminum and steel to someone else. So this is one of those where likely the impact will be felt by US manufacturers and US consumers in the end. So misled kind of policy once more. For Brazil, 50% tariff, it was important for a few reasons. First, Brazil at that moment was the only country that was not on Trump's big board on April 2nd, on Liberation Day, to get a letter notifying them of high tariffs. It was the first. Canada became the second just a few hours after. And second one is that because they're quoting mostly political reasons, it's the Bolsonaro trial that is being quoted there. And Brazil has a trade deficit with the US. The US has a trade surplus with Brazil, so it's not validated by the data on trade. So that makes it awkward. That set a precedent. That kind of set the tone that Mr. Trump now can use anything and everything that he has on his desk at that moment to weaponize trade policy. So that kind of sets a precedent. After that, a few hours later, we had Trump putting 35% tariffs on Canada. That was unexpected, but the good news is that the exemptions for USMCA would continue to hold, it seems. This is what Bloomberg is reporting, but who knows, because the details are pretty scarce here. So that would hit about only 10% of Canadian exports, so still sizable, regional, sectoral impacts, but it's not 35% on everything, so it's not the worst case scenario. And maybe the biggest part of the announcements this week is that he's highing 15 to 20% tariffs as a floor. It used to be 10. If it's 15 to 20, then if you do the arithmetic, you pretty much get to an average tariff rate of 20-25% for the US, and this is exactly the worst case scenario that was seen in early April. So it's sizable, it's very important, and of course it will, if it holds, it will show up in the US economic data very severely. Higher inflation, detrimental to growth, so it will happen if it sticks. So let's see if there are deals that are struck, but if the floor is at 15-20, that's starting to be a pretty steep figure here. Now Canada is aiming for a new trade deal by August 1st. Mr. Carney tweeted on that, so let's see if we're able to negotiate something. But Mr. Trump did mention supply management in his letter to the US. So let's see if there are some, if this is the sticking point, and how can we get out of this negotiation in good shape. So it's going to be interesting over the next few weeks. Now maybe looking at the markets. First one is valuations on equities, and I've used this chart a few times. The line on top is the US. Of course, it's more expensive because tech is more expensive, and tech is such a large part of the index now that it distorts the index. But if you look at the recent history, now the valuation of the US stock market is in line, if not above, the recent high. So the US stock market is back to being quite expensive versus its history and versus other markets as well. So the same story, we do not dislike the US stock market. We just think that we need to be picky. You need to be invested maybe more in tech. You need to have your growth exposure in the US. We did put in some protection for the month of August in case an accident happens in the market. You never know. But we are still favoring other regions. So we're still well invested in equities. In fact, we have a full position in equities, but we favor Canadian stock market, European stock market, Japanese stock markets, emerging markets. So all of those regions are regions that we think have better risk reward profiles. The Canadian stock market in red, now it's back into expensive territory, but versus its own history, it's not as stretched as the US. There are some good reasons for that. The Canadian economy is doing well, it's more resilient. Higher commodity prices could be helping, and we just had the jobs report this morning, which I will discuss in a few minutes here, which was a blowout. So the Canadian economy is still doing good despite the trade uncertainty. European stock market, there are some good factors to support it going forward. Investment in infrastructure, investment in defense, it could help here. And again, also this attractiveness of other regions versus the US for, let's say, political or reputational reasons also could be a factor here as well. So again, investing in equities is still necessary. We're still very constructive, but the geographical aspect, the diversification aspect of things remains very important. Now looking at the US dollar, down about 10% since the recent highs. We think that we are in a secular decline. We still think that means that there are still some losses to come. Everything about the trade situation, which will be detrimental to the U.S. economy, the perception of U.S. assets by foreign investors. So all of that, we still think that this could push the USD lower over the coming few quarters, maybe even years. And again, to link this to the equity conversation, if you do not have access to hedging of the currency in the funds that you invest in, whether it's for your money for your clients, then you need to take into consideration that the weaker USD will be shaving off returns for investments in the US. So that's a very important part of the conversation here. It's good when the USD is getting stronger, but when it's getting weaker, you need to adjust your positioning, you need to adjust your view, the tools that you use, or maybe you need to invest outside of the US to shield yourself from that effect. Now within fixed income, the long-term rates are high, they're attractive. There are some fiscal risks out there that are making us still be cautious on going all in on duration, but the curve is very steep, so you have a good roll rate that can add some value. In the next 12 months, the Fed is set to cut rates, so that will be helping returns at the bottom end of the curve. But here, if you look at corporate bonds, the all-in rate, so the spreads plus the government rates, are again still high enough to provide a solid margin of safety. So that gives you very attractive opportunities to invest in credit, in fixed income, and have that diversification in the portfolios work for you. So we're very constructive again on markets. We can have some volatility in the short run. There's always something going on. Trade uncertainty is one thing, but you have lots of tools in the arsenal here. So staying invested, just going where the returns are more, the valuations are more attractive. Let's say the returns can be more attractive is the way to go. So now Canada had a blowout jobs report amid a trade uncertainty. So we added 83,000 jobs in June, so very strong. When you look on the right, the unemployment rate is falling a little bit in Canada. Higher in Quebec. In Ontario, it remains high as well. Those are the two provinces where trade policy hits the most, of course, for the auto industry. In Quebec, it's more about the metal exports, but also, you have this creation of, I would say this demographic dividend that is underlying the Canadian economy. We've had massive inflows of immigrants over the last few years. They went to Toronto at first. Of course, that pushed the unemployment rate in Ontario higher because it's hard to keep pace with all of this. But now you have this diffusion of the population across the country, higher home prices elsewhere in the country, more home buying, more economic activity, more demand. That means to higher jobs creation as well. So we're starting to see this impact, this positive tailwind to the Canadian economy happen as well. So a very positive number here. Nothing says that we won't see a reversal of that in the coming months with the trade policy spat that we're seeing, but the month of June was a very positive surprise here. So what we'll be watching next week in Canada, we'll have CPI inflation, same thing in the US. Canada will have the business barometer, CFIB, small businesses. In the US, retail sales and the total net tick flows. What's that? That's the official data on the purchases and sales from foreign investors of US equities, bonds. So the question is, are global investors stepping away from the US market, or are they still investing in the US market? Well, we'll have some idea coming with this data. So again, a reminder, I will be off next week, so there won't be a review on July 18. The next one will be on July 25. So if you have some vacations planned as well, please try to enjoy them. And if you enjoy the content here, please share, and of course come back again at the next edition, which will be in 2 weeks on July 25th.